It's boring. It's doing boring stuff in a country, literally boring. It's boring holes into the ground. But when you started to give out the numbers, it went from a loose analogy to a very tight alignment with Peter Lynch's Dream Stock Brigade, the fact that revenues increased 37% year over year. And then a point you made, which you, I think, just brushed past, but is vitally important. You said return on equity has hit something like 33%. And for those astute listeners who recall the interview I had with Chris Mayer, author of 100 Baggers and Where to Find Them, and those people who've read One Up on Wall Street, a business with a return on equity of 20% or greater pushes that business into a quite an elite category.
Emmet, how we getting on?
We're back, Mike. Where are the weeks going?
I know, it's Christmas soon.
Ugh, unbelievable. That year just felt like a hiccup. It was just so fast. I think I should have just left the Christmas decorations up.
Yeah, there's a bit of that in it. I have my flights booked home, and it's kind of once you get close to Christmas, it's kind of the top of mind. You know, especially if you're living away from home. I think as well, it's that big pilgrimage so many people, especially my age, make every year, and you know, it kind of almost gets sweeter with age in a small sense because you start building these random traditions, and there's the exact people you see only once a year, and it's great. So yeah,
it is.
really
It's lovely. It is lovely, actually. My local sandwich place where I went up to meet our CMO Frank for lunch today, plugging another local business as I did last week, is called Greenville, and it does the best Christmas sandwich in the world. If you ate
Is
it
that
every
the
day,
little like hut on the side of the road? It's at a roundabout kind of.
It's by the roundabout for sure, but it's not a hut. It's
Not a hut, but it's proper. Yeah,
proper premises. But they have a Christmas sandwich, which is basically a Christmas dinner between two pieces of bread. And I had the first one today. But if you ate it every day, it would be the fast track to gaining a kilo a week. So
100%. Well, there's that thing it's like an enzyme in turkey or something that makes you sleepy. Have you heard about that?
Wow.
Yeah,
I'll tell you what.
it's the food coma like is scientific.
But it's in Turkey. But your turkey was like this fat-free, high-protein superfood, and now suddenly it's putting us to sleep.
I don't know. It's
No,
one of
you
those
don't, I think.
headlines you read on social media that you're like, yeah, that's fact. That'll be forever enshrined in my brain.
Yeah. 10 biscuits your ma would never buy you. I remember some of the world's biggest events. I remember a super big event. I won't even say what it is, lest people think I'm insensitive. One of the biggest events of my life was unfurling, and my colleagues and I were all watching it on the internet. And one of the lads said, look at that article, 10 biscuits your ma would never buy you. Click on that. And we all took a break from the world news to read the list of 10 bickies that your mammy would never buy to score them. But anyway, whenever I think of internet trivia, I always think 10 biscuits your ma would never buy you. Ma, by the way, to our American listeners, is it a particularly Dublin way of referring to your mother? Me ma? My mother?
I think that's
me
fair.
ma? Yeah. I'm sure it's across the country, but especially Dublin.
Yeah, I would definitely go mammy as you get very country.
Oh, there's 10 words for mother in Ireland. Mam, mum, mam, mammy, all this kind of stuff. But anyway, that's another podcast.
Yeah, so this podcast again, we're in the middle of Nexus III. We haven't forgot about it. We did a great episode last week. We discussed two stocks. Be very impressed if anyone has ever heard of them before that episode, but it just goes to show that there are hidden gems out there, and that's what Nexus is out to prove. So we're getting into it a small bit again today. We're not giving anything away. We're not going to be as generous as last week, but
yeah. Well, let me intervene and just say to everyone, we have an ask. Subscribe to the podcast. I mean, come on. What do we ask from you people? We ask you to open your podcast thing, Spotify or Apple Podcast, and subscribe. It doesn't cost a penny. It costs 3 seconds. Come on, folks. Don't just listen. Give us a score on the scoreboard. And as you said last week, Mike, we both picked two former Nexus selections, pitched them to each other, and decided how we'd split 10 grand across them. And I think we both apportioned the lion's share to the one that you pitched, which was a serial acquirer. And last night we figured it would be fun for you to tease one of the first 5 that just went live in Nexus 3 on Monday. And then separately, I'm going to talk about a fascinating story of a boardroom battle happening over in Hollywood, no less. I had read all of the Nexus 3 stocks, the first five, last week, needless to say. And I was just reading before I went live, and I have to say, they are unbelievable, but not just because I'd never heard of them before, um, but because two of the five Nexus 3 stocks have the highest score in the 35 stock history of Nexus. That's 15 stocks that came from Nexus 1, 15 stocks came in Nexus 2, and now five in Nexus 3. And we also have several dozen more in the My Wall Street Labs, as we call it, and they will emerge as 10 more selections for Nexus 3 in the months ahead. But wait, hold. One of the five, I lie, one of the five I had heard of because it was called out as a favorite investment by one of the guests at a Vesticon in August, just gone. And completely coincidentally, it was isolated by Nexus. So before I hand over to you, Mike, I'd like to remind our listeners that for a few more days, you can get Nexus 3 for half price. That's $1,000 off. You only pay $999, and that includes Nexus 1, which was $2,000, and Nexus 2, which was $2,000, free of charge. And all you need to do is email frank@mywallstreet.com. It's all you need for a great Christmas, folks. And I mean Christmas 2035, because in the next 10 years, I think we'll have found some life-changing stocks in Nexus 3. So grab that discount right now today while it's there, folks. You get Nexus 1 and 2 free of charge for half price on Nexus 3. Email frank@mywallstreet.com to guarantee and lock in that discount. Apart from us providing an outstanding service at a fraction of a cost to what some of the giant businesses in the US would charge, you're also helping an Irish enterprise, and you are getting something of face-melting value. So sign up today. frank@mywallst.com.
Okay, so we're getting into it, as you were saying. We're not going to give it away this time. We gave away one from 1 and 2. I don't think we can give away one for 3, especially because it's out. It's about a day old as we're recording this episode. But we are going to discuss the company and why it's kind of why we discovered it with Nexus, what attributes it has, and give that teaser that kind of shows the thinking behind the selection process and shows the thinking behind these are the kind of businesses that are out there. If you look hard enough, if you have the right screening process, if you have the kind of technology we've been able to use to uncover these stocks. So the company in question is an Aussie company, and it's kind of quietly powering some of the biggest names in mining, energy, and infrastructure down there. So now remember, mining alone is worth more than 300 billion Aussie dollars every year. You throw in other key infrastructure like energy and utilities, and you kind of got the entire engine of the nation there.
But that's it. It is the engine of the nation. Like I'm not to, sorry, I don't mean to interrupt your flow, but when you think of there is generally an industry that defines a nation. Of course, there are many industries. There's as many industries as you can imagine to define every country, but there's one that seems to be core to the heritage of every country. If we talk about America or Sweden or Ireland, when you go to Australia, I think 9 out of 10 people would say mining is in the DNA of that country and the economic output.
Absolutely. And I think seeing a company of this size, it's a small company, I think it's below 1 billion market cap in US dollars, or no, 2 billion, right? And seeing a company of this size with this potential growth trajectory in such a valuable industry, supporting it, it isn't like Rio Tinto, it isn't like one of the massive giants in it, but it is their supplier in a sense. It is a service player in that industry for them, and it becomes very, very, very important when you kind of break it down what the business does. So it's a holding company of 26 subsidiaries, serves, as I said, the blue chip client base. Each company has a very specific niche, whether it is under kind of maintenance, shutdown, breakdown, brownfield upgrade services for critical fixed plant assets. But each one falls under kind of the similar classification of highly skilled, specialized workforce with a focus on basically the maintenance of assets. So you have these huge. If you ever seen any kind of footage or social media clips, I'd say a lot of people around my age will see these FIFO kind of trying to sell you a dream clips, and just the scale of some of the mining operations down there, and you look at the size of these machines, and the industry that's built around keeping them on track is where this business thrives. So it's critical nature, obviously. And like if we're talking about, say, an excavator breaking down in the outback, a company like Rio Tinto, which is one of this company's key clients, it has no choice but to fix it as fast as humanly possible, because the money it loses while a key asset like that is offline far outweighs the repair costs. So in that sense, there is a bit of pricing power, even though it's a very small supplier to a much larger company. There's a bit of pricing power in the sense of, if you are reliable, that's all the customer cares about. The price is not as important, because the opportunity cost, if something like exactly an excavator in the outback is offline, is huge to a company like Rio Tinto. So we're just going to go through quickly how it popped up for selection for Nexus. So it's founder led, and between the company director and his co-founders, who are both still executive directors, they own about 60% of the company. Now, not only that, but they have actually bought more shares since last year's IPO. And I feel like this is, throughout Nexus, this is one of the core themes. You just can't beat skin in the game. And we've seen it. It's one of the key, I suppose, attributes of successful businesses in the stock market. Not that every business with high insider ownership will do well, but it is a proven fact that businesses with high insider ownership do better than businesses without. So you just can't beat skin in the game. And it's also got a very strong owner-operator culture among top management, and especially acquired management. So if this company acquires a new business, they will really try to incentivize that ex-owner manager with share options, so they stay kind of aligned with shareholders and with that business, and it really helps with the culture, motivation, and everything like that. So since 2021, it's tripled revenue while boosting profitability. Return on equity went from 25% in 2021 to 34% last year. So fiscal 2025, which is just over for them. Last year, fiscal 25, they posted 37% revenue jump. Profits and cash flow grew even faster, so some operating leverage there at play as well. They have a huge order backlog, so their order backlog for 2026 and beyond is greater than their revenue from 2025, which kind of goes a lot of transparency towards future revenues, which is something as investors we really need to see. And then it's also got growth fueled by acquisitions in especially civil and electrical services. So there's some trends there in Australia with electrification, decarbonization, that it's really riding at the minute. So that all adds up to a Nexus score of 90 out of 100, which, as you mentioned in the preview, it's as good as you get, really. I'm not sure how many companies we found over the last 3 years with a score of 90 or higher. I think we can count them on one hand anyways.
I think there was only 3. One was last year, 2 is this year.
Yeah, and there might have been a Nexus 1. But whatever it is, and it was on a quantitative basis, it's like truly elite, and the numbers are singing off the page for us. Acquisitions are a major growth pillar for the business. They like buying well-priced, mid-sized specialists between kind of 10 to 50 million Aussie dollars in sales. They want to keep existing management in place to maintain focus and continuity. And then because these businesses are in similar fields, there's major cross-selling opportunities once they're acquired. So the acquired business can also avail of, say, shared resources, the company's customer logbook, other synergies like that. So it becomes much more efficient once it becomes under the one umbrella. Very good balance sheet management. Net debt is roughly equal to years worth of EBITDA, meaning the company has its borrowings covered very comfortably. Growing cash flow at about 50% a year also helps matters quite a bit there. There's a lot to like. There's trends in the mining and excavation industry that are playing into its hands. Stuff like increasing extreme weather conditions are driving more resilience upgrades and rapid response programs. The company's bread and butter, essentially. So clients are actually relying on aging assets more and more as well, which again require more ongoing maintenance, emergency repairs, life extensions, stuff like that. I mentioned decarbonization efforts, automation efforts. A lot of higher demand here, especially in kind of electrical upgrades and ongoing maintenance there too. So lots of stuff is falling into its hands at the minute. There's obviously some risks as well. This is a cyclical industry, so we are seeing trends on the way up for it at the minute. That doesn't always last. Because a big chunk of the revenue comes from maintenance contracts, this won't be as kind of exposed as, say, its actual, clients, but it is definitely a risk there. A big chunk of revenues comes from iron ore. So that is an exposure for sure. But again, strong long-term contracts, reliable customers, they help cushion the blow here. And the last thing I'll say on risk is that they like to fund acquisitions with equity, which means that we are seeing dilutive events occur. But yeah,
With
those
cash
are
remaining strong and the business keeping debt low.
absolutely, yes. So like it's kind of one or the other basically, and this is how they're
Mm,
deciding to do it.
mm.
But all in all, it looks like seriously well-oiled machine. It's got all the components of a long-term compounder in my eyes: strong leadership, diversified service portfolio, and really firm grip on cash flow and margin. So in terms of the kind of boring industrial player, I really like everything it's doing. I like its size. I like the management's positioning. I like the ownership. I just think this is a really, really strong stock. You would never have heard of it. Like,
No,
you know,
definitely.
big,
I had never heard of it. And Mike, that's a reasonable segue into something we haven't discussed on this podcast for a very long time, which is probably what I believe is the only book every stock investor should read. And it's a perfect dovetail into this point because my son asked me during the week for some more investing books to read. And I said, "Have you read One Up on Wall Street by Peter Lynch?" He said, "No." And I couldn't believe it because he's a great investor, my kid. And I said, "Oh, you have to read that." So I didn't read it till I was on my honeymoon, and that's like 22 years ago. So I was late reading it, and he's got such an advantage reading it age 19. But it was the book was written, as far as I recall, in 1987 by Peter Lynch, who's a famous, legendary, I dare say, a fund manager who worked for Fidelity in New York in from I reckon from the early 70s, mid to early 70s to mid to late 80s. I reckon. I'm not too sure. You'll know all about it as soon as you start to read the book. But the reason the book is so compelling is that it's written for every person. And the title One Up on Wall Street is meant to impute that the average person going about their lives, no matter where they live, will see things that some high paid analyst sitting on Wall Street will never see. And they'll spot trends that analyst in New York City is unaware of. And the book goes into the attributes of what makes a great investment. And as you were describing that company, whose name I will not say, it was green light, green light, green light, green light. Like Peter Lynch says, buy a boring, unloved business. Like, for example, I think in the book he uses a company that he bought shares in called Crown, Cork and Seal, if I recall correctly. And he describes that there was a business that when you took the lid off Coca-Cola, at least back in those days, and looked inside the lid, there was a small O-ring, a rubber ring, which stopped the fluid spill out of the bottle. And there was a company with a monopoly in those little O-rings. And he said Crown, Cork and Seal was one of the greatest investments of his life because it was boring, it was unglamorous, and it was unloved, and it was unspotted, which is exactly how I would kind of reflect back what you said to me about this company, which got the jaw-dropping Nexus score. It's boring. It's doing boring stuff in a country, literally boring. It's boring holes into the ground. But it is an uninteresting business servicing a country that's not synonymous with high tech. I mean, they've done it, of course, but their core industry, as we said, is all things to do with mining. So, so that was when you were describing the business. I was thinking this is One Up on Wall Street, boring stuff. But when you started to give out the numbers, it went from a loose analogy to a very tight alignment with Peter Lynch's Dream Stock Brigade. The fact that revenues increased 37% year over year, the fact that net profit was up 74%, free cash flow was up, gross margins improving. I think you said from like 30%. Is that right? Gross margins around 30%. Operating margins up, up, up. Everything is up. And then a point you made, which you I think just brushed past, but is vitally important. You said return on equity has hit something like 33%, 34%, up from around 30% a year ago. And for those astute listeners who recall the interview I had with Chris Mayer, author of 100 Baggers and Where to Find Them, and those people who've read One Up on Wall Street, a business with a return on equity of 20% or greater pushes that business into a quite an elite category. When you combine it with the fact that it's founder led and those founders are buying shares, there is an explosive signal which suggests, with history and the weight of all the data behind it, that we are looking at a rare investment opportunity. And I almost certainly will pitch this in Horizon in the year ahead. And I have a question for you, Mike. Are you going to invest in it?
Yes, I think so. I think I've outlined 2 stocks from the original 5. I'd like to buy all 5, really, but 2 stocks from
Yeah.
the original 5 that I'm very bullish and plan to invest on post
And if I
publishing.
invest in it, which I'd like to do, people who are subscribed to Horizon will know all about it. I just would prefer if it has an ADR, and I doubt it does if it only listed on the AX a year ago, ASX.
Yeah, no, I've looked it up. It's on interactive brokers, so that'll be
Everything
the thing.
is.
Yeah,
Everything is.
but you
IB,
can,
OG.
and we'll find it if you're looking for it. But yeah, no, and it's. I'm glad you brought up the Peter Lynch thing, because it kind of feeds into what we're saying about uncovering these hidden gems and finding the stocks that aren't being covered by Wall Street. And I think with the stock with those kind of credentials and numbers that jump off the page like that, it's tougher and tougher to find them on the US markets. It's not impossible, but it is
Yeah.
rarer and rarer and
It's
rarer.
way harder. Oh, look, I've been at this game for, well, in my private life, I've been at this game for 30 years, and I've been professionally at this game for 12 years. And it is getting harder. There's no question about it. I think it was in last week's podcast or the one before. That's all a blur. We were talking about how companies are IPOing way later. And
Yeah,
in America, but at least the rest of the world, that kind of infinite capital off the IPO market effect is less prevalent. So if you're running a small or medium upward bound business that needs to unlock cash quick, IPO is still the game that you should play.
very much so. And that's a good segue into what we're doing next, because we're going to discuss a company that you managed to buy that would never in any way or time or sense or any matter of the word be public
No,
at
that's
the time
true.
you bought it. If it
Yeah,
came
no.
around, now. So
Well,
we're
yeah,
going into the
they're a player in the story. Yeah, there is a very big story in Tinseltown that, if all things are equal, Mike Anne-Marie, our resident Hollywood and movie industry genius, would cover. But as it's you and me, I thought I'd dig into a hot story, because seemingly the ground is shifting beneath Hollywood. I will say once again, but it really feels like this is a big one, because one of the biggest media consolidation stories in decades, I might say, are possibly ever, is decisively entering a next phase, and it feels like a final phase. And specifically, what I'm referring to is Warner Brothers. Everyone knows Warner Brothers. They've seen the brand at the front of movies since they were children. Warner Brothers Discovery, as they're now known, Discovery Channel and Warner Brothers merged a few years ago. So Warner Brothers Discovery, the owner of Warner Brothers Studios, HBO, HBO Max, CNN, the Turner Networks, DC
yeah.
Comics. DC Comics is owned by Warner Brothers Discovery, so they own Superman, and of course the Discovery Channel, and a sprawling catalog that stretches across the entire media zeitgeist. Is that a bullshitty thing? It is absolutely known
It's
to
everywhere.
everyone. Everywhere.
It's interesting as well, because the Warner Brothers Discovery kind of are two sides of it. Warner
Yes,
Brothers is the studio, and then HBO is kind of the TV side, and then you have Discovery, which is the cable news network.
correct.
And
Um,
it's kind of important distinction when it comes down to what we're talking about as well.
Correct. There's nobody listening to this podcast who doesn't acutely know who Harry Potter is, while Warner Brothers Discovery owns the Harry Potter movie franchise. There's nobody listening to this who hasn't heard of Game of Thrones. Ditto. It owns so many hot assets. It's just unbelievable. I was going to run a quiz with you, but actually, it was the estate is so vast, I couldn't make sense of it. But it is all officially up for sale. And there is a 0.0 chance that if you listen to this podcast that you've not interacted with hundreds or thousands of Warner Brothers Discovery assets in your life. So the first round of bids is now in to buy the whole kit and caboodle, or maybe nearly. I'll tell you a little more about that. And the early contenders are what you'd expect, and it's a trio of bidders: Paramount, who we all I think all know, Comcast, and Netflix, which is what you were alluding to at the start of the piece. And each has submitted a non-binding offer, which kicked off a competitive process, which is really going to reshape film and TV and the streaming world for years to come. That's not too small a thing to say, because like we discussed on this podcast at length, when Amazon via Prime bought MGM, Metro Goldwyn Mayer, in 2022, and they paid $8.45 billion for the MGM studios and all the franchises, meaning that, as everyone knows at this stage, Prime now owns the James Bond franchise, which is shared with the Broccoli family, and the backstory that's quite interesting, but not for now. Prime owns Rocky and Creed and the co-production rights to The Handmaid's Tale and other kind of, I suppose, iconic media properties like Legally Blonde and RoboCop and Stargate and the Pink Panther and Silence of the Lambs. Like, they also have a big, deep well of assets. But honestly, the MGM title board still feels very kind of inane when you put it shoulder to shoulder with what's up for sale now. So, so this is an auction lot that's way, way bigger than the MGM purchase by Prime. And to understand how we arrived here, it's really worth rewinding to the formation of Warner Brothers Discovery, which was also in 2022. So the merger between Warner Brothers and Discovery created this, as I said, giant content empire, but it was also mega indebted company at the time. And the economics of streaming were really changing fast. And I do recall Anne-Marie sitting with us explaining in depth the mire of debt that Warner Brothers and Discovery were sitting in. And it seemed like the only business unencumbered by an iceberg of debt was Netflix. So the streaming boom of the 2010s had conditioned investors to kind of think, oh yeah, we accept losses in exchange for mega growth. And as a shareholder in Netflix over the years, we politely ignored that little thing called revenue, because every number, Reed Hastings, the founder of Netflix, and Ted Santos and the crew would come out and talk about the number of subscribers, which was always eye-watering. They would jump the number of subscribers quarter by quarter, and an onlooker, an investor, and a shareholder would know that this was a proxy for future revenue. But by 2022 and 2023, as interest rates started to rise and markets got a lot tighter, the tolerance for kind of non-revenue stories really disappeared almost overnight, you could say. And suddenly investors wanted profitability. Don't talk to us about the number of customers. Tell us how much cash came in the till, and tell us how much cash was left in the till after you paid everyone on the studio lot, so to speak. And companies like Disney was laying off tens of thousands of employees and slashed content budgets. And Warner Brothers Discovery found itself particularly exposed. It had inherited this vast, expansive HBO Max platform, an aging suite of linear cable networks, which I think an awful lot of Gen, whatever it is, Gen young people, Gen Y, is Gen Y the young one?
Gen Z.
A whole bunch of Gen Z would not have any cultural affiliation with a cable network. They're like, what is that? I don't even know what it is. But basically HBO, say Warner Brothers Discovery had a multi-billion dollar debt loading. So throughout 2023 and 2024, while you and I were watching Warner Brothers Discovery's The Last of Us, which is one of their shows, they were backstage cutting costs aggressively. I mean, just imagine in the Last of Us studio, Mike, picture this. The sandwich guy comes in with his trolley of Sambos, and he says to the director, "Do you want your sandwich, sir?" And the director goes, "Yeah, I'll have a pastrami. And by the way, you're fired. And so's your assistant, and so's your runner, and so am I." That's kind of what happened. That's what was happening backstage. But we were sitting there watching The Last of Us going, "That's great now, great production values." Meanwhile, there's a sandwich guy driving home sad in Hollywood. They were laying off everyone. But some of the more concrete decisions where like they shelved films that were nearly done, that were kind of just, they just needed
Yeah,
to
this
be
is the famous Batgirl movie, isn't it?
one of many. They there was just, I mean, it was 90% complete, but the opportunity cost, or sunk cost fallacy, I should say, they looked at it and said, doesn't matter. We're not spending that money to get it out the door. They pulled titles off HBO Max. They were canceling all types of projects mid production. And as a consequence, I remember at the time they were getting criticized left, right, and center by the Hollywood Observer and what is the Screenwriters Guild? We've just got the acting
I
and
think that's
screen
it. Screenwriters Guild, yeah.
Screen
SAG.
where, yeah,
SAG is the actors.
that's the one. Yeah, where there was a lot of discontent at the time because they seemed like they had just basically started to act in a very unpredictable, erratic, and nonsensical way. But others, like Sandwich Guy and his helper, were just simply a sign of the company scrambling to refinance its balance sheet. But another reality was emerging backstage, as it were. WBD, as I'm going to call them now, Warner Brothers Discovery, WBD could no longer compete on equal footing with companies like Netflix and Amazon and Apple. Like, I think when you talk about TV shows, certainly in this part of the world, and I think in most parts of the developed world, everyone is subscribed to one of those three, and usually more than one of them. Netflix, Prime, and Apple are the ones that people put in the bedrock of their entertainment stack, and then other stuff is discretionary, and their cash reserves dwarves everything else. Like, I mean, seriously, Netflix, Amazon, and Apple, like, who wants to go to a cash war with those lads? So a couple of months ago, the writing was on the wall, and WBD, Warner Brothers Discovery, announced it was exploring strategic alternatives, which we all know is code language for trying to figure it all out. And internally, discussions were going on about splitting the company into two pieces, one containing the streaming and the studio assets, and the other, the declining cable channels. And the logic was that any buyer, or a lot of buyers, the majority of buyers would only want the good assets: HBO, Warner Brothers Studios, the streaming business, the kind of more contemporary first world, or I should say latest tech products. And they'd want nothing to do with the old cable bundles. And that is why both Netflix and Comcast have bid for only the studio and streaming divisions, because those two, Netflix and Comcast, it's aligned with their distribution model, if you like. So they want HBO, they want Harry Potter, they want DC, they want the Looney Tunes and Friends and Succession, and this vast, vast catalog of entertainment that we all use. But they do not want CNN, they don't want TNT, they don't want TBS or HGTV. And Paramount, on the other
Mm.
hand, the third bidder, has submitted an offer for the entire company. And that offer reportedly has valued WBD at just under $60 billion, which represents its fourth attempt to buy the company. And
Yeah.
those are, yeah, exactly. And do
But
you remember Anne
it's
Marie?
worth discussing Paramount as well. Paramount Skydance is the new company, and it's
Correct. Yes.
completely
Yes.
spearheaded by this fella David Ellison, who is
Correct.
Larry Ellison's son.
Correct. So we're
Who
talking about mega wealth. I mean, Larry Ellison is always in the top five wealthiest people in the world, and it's their determination to acquire Warner, and it's become one of the most interesting subplots in Hollywood today. It's like its own movie itself.
it is, and you're looking at the whole thing and the consolidation of it. So, like, as in Skydance would say David Ellison's original vehicle, and he used it to acquire Paramount. He's kind of, the next step is to acquire Warner Brothers Discovery. In their eyes, their best kind of way of acquiring the assets is to acquire the company entirely, which would match much better than say Comcast or Netflix in terms of what they want, which is just Warner Brothers. Maybe if they find out, if Warner Brothers Discovery finds out that they're going to get a better deal with say selling off the studio, Warner Brothers Studio, selling off HBO, all the rest, and then maybe keeping Discovery, keeping the cable channels, and trying to run that as a business itself. But however it looks like there's going to be serious consolidation in the studio space in Hollywood, in movies, whether that's a good thing or a bad thing. Like, it's really interesting. So like, from you, a very unique perspective from a long-term Netflix shareholder, in the sense of what does this mean for the company, either if it wins the bid or if it doesn't win the bid? Because if it doesn't win the bid, you have introduced a new kind of rival with
Yeah,
huge
that's right.
content library, huge expansive network that is putting together. I know Paramount streaming efforts aren't really up to much at the minute.
Yeah,
Now, if Paramount Skydance win out that and they have the whole HBO library, what does that look like then? Same with
yes,
Comcast and Peacock. What does
yes.
that look like if you add HBO to Peacock and all the rest? So it seems that the bid from Netflix is almost like, well, wait, we kind of have to do this almost as a defensive action to stop kind of, they were really benefiting from the streaming landscape being so fragmented,
Yeah,
and
totally.
all these companies not really being able to figure it out and not spend enough money, and kind of losing money on subscribers, and then the price went up and just didn't have enough content. And in the sense of, if one of the other two bidders comes out on top in this, does that bring in a real threat to Netflix?
Well, this is true. I mean, like the motivations here on all sides are gargantuan, and I think there's a plus, a giant plus, and a giant minus. And I'm sure the bidders, all the bidders, realize. Well, I think the Ellison dad and son team are an exception. They're very clear in what they want. But
Yeah.
for
And
Netflix,
and like, sorry, I'm cutting
yeah,
across you here, but like, as in the political implications of that as well are huge, because we've seen basically the Trump administration step in to allow the acquisition go through of Paramount quite easily. That's in their back pocket as well, because Larry Ellison's very friendly with Trump and he's a
oh, he
big
is.
donor and all the rest, and
And
that,
that's
like,
huge. That's huge. You
huge.
cannot, I mean, that's not a nothing thing. And that's a very good example of where the human brain can assess something that I can't say AI won't or doesn't, but it's a very important input to consideration of something that has very grey boundaries, but very very distinct information within. Like, so for Netflix, if we'll come on to that if we may in a minute, but for Netflix, acquiring Warner's films and HBO's legendary slate would of course bolster that shelf of titles. When we open Netflix, most of us go rooting for something that looks interesting and unwatched. And generally, there are movies, and like, my perception of Netflix is it has an absolute stack of great quality stuff, but a lot of it is Netflix produced. But if, as I said, that you open it up and you're looking at, well, Friends is already in there, but you're looking at all these titles, hundreds of titles. Like I've measured, you can see the immediate benefit for Netflix and acquisition and retention. Now it already dominates subscriber counts, but owning this catalog would really, I think it would elevate it further, and I think their acquisition machine would just suddenly get even bigger, and would also give them the leverage to accelerate a new strategy, which was releasing its films theatrically, like
Well,
in a more like systemic way, if you know what I mean.
I'm glad you brought that up, because there is the thought of the strategy change if this acquisition goes through
Yes.
in Netflix's
Yeah.
favor. Is that, does that turn Netflix into a, you know theater release company all of a
Yeah.
sudden, which it wasn't before? Like, it does, it does in a sense, like, as in, it releases certain big picture
It does.
films,
Yeah. The Irishman was one that I remember we were all dying to see in the cinemas, but it was a Netflix
but it,
production.
but it also, like, it might be in the cinema for a couple of weeks and then it's on
That's right.
Netflix, and like, that's the difference. Like, is, and it's not, its core goal for those cinema releases are as much for award season, rather than
Yeah.
actually, this is the commercial vehicle we want to take with this film. Whereas, I don't know, if they release a new Batman, um, which is within the Warner Brothers Discovery catalog.
Yeah.
That can't go on Netflix first, can it?
Oh, you're
Like,
absolutely no. They've actually said. I mean, Netflix has already said that it will start putting Warner films into the cinemas, or I suppose continue putting Warner films into cinemas, which is a major philosophical shift for a company that's always prioritized streaming,
yeah,
and it's really very retro. Like it's all, it's like I wonder if they're going to go into posting DVDs after that. Do you know?
they're
It's
going back to it.
hold on, you're putting cinemas and our movies into the cinema, and now you're gonna post DVDs, and then they're gonna. But wait, we've an
Yeah,
innovation. It's called Betamax, and everyone is like, "Hold on a minute, you can't be." But anyway, yeah. So, but it does face real hurdles. The company has never made a major acquisition. Like it's amazing how organic and pure Netflix has been.
yeah,
Everything it's done, it's built in house, built it out steadily, and done a beautiful job on it. Acquisitions, every MBA student will know, there's the MBA case study of what diversification, actually a word coined by Peter Lynch and One Up on Wall Street, that diversification is a word that's paraded around as a good thing, and acquisition can be a diversification strand of diversification, but it is actually a huge risk, and buying businesses are notoriously gnarly and sticky, and I mean, it did buy. I'm lying. It did buy something ages ago. I bought something for like $700 million a few years ago. I have that number stuck in my head, but I don't remember even what it was. But it's
yeah.
nothing
So
compared
that's
to
nothing. Like, as in, if
nothing.
Warner Brothers Discovery is close to 60, but I think 2350
60.
was the most
Yeah,
recent Paramount Skydance offer, which
correct.
puts it at 58, 59 billion. And now Netflix's offer is going to be less than that because they're just going after Warner Brothers.
Correct. The streaming bit. But I
But
mean,
even
60
still, you're looking
billion
at
is a
30, 40
ginormous.
billion. I'm not sure.
Well, it's a ginormous acquisition, and
Yeah.
by any company metric, irrespective of their pedigree, we talk on this podcast about serial acquirers. Like you never see a 60 billion acquisition by serial acquirer, a business that has made its business in acquiring companies just doesn't buy 60. That is a giant acquisition. And we can see why. I've listed off, some of the titles here, and they are all in their own right absolute monsters. And it would be transformational, as I said, but it would also be financially risky.
Yeah.
Netflix has the cash to go for the deal. But they are a very, very disciplined capital um, uh, appropriation, or what's the right word? They use.
Allocated.
Thank you. They're a very disciplined capital allocator, and I was reading some analysts last night that believe Netflix bid is simply an exercise in due diligence, and they will not do it. That it's really a sign of it's not a sign of intent, and it could indeed escalate a bidding war that they don't intend closing out. So you can see backstage to be a ton of deeper
Yeah.
strategic thinking. Like why would they not indicate interest until they're not interested?
And then, like, we'll go. So we kind of discuss what would happen if Netflix would win that bid, and
Mm,
there's downstream effects we haven't even talked about yet. Like,
yeah.
you're looking at cinema stocks like AMC and Regal, and what
Yes.
happens to them, and
Yes. Yeah.
IMAX would be a bit different because I think the scale of an IMAX movie
The
will always
draw.
be the attraction, but
Yeah, that's
not so
right.
much just going to the cinema for cinema's sake. But
Yeah.
we'll say if Paramount or Comcast come in,
Yeah.
what's the implications then? Is this creating this new content giant that Netflix all of a sudden has a true competitor there?
Oh,
Like,
totally. Well,
is
if it would,
Paramount Plus the new streaming kind
that
of
is
second
that
in
is true.
command?
Well, let's do Paramount in 1 minute, but let's just tick off the Comcast strategy, and it owns NBC Universal Studios, and it's also a very interesting one, and it has very clear strategic benefits in acquiring Warner's studio and streaming assets. But Comcast faces a lot of political challenges, and there's no two ways to say it because they own MSNBC. MSNBC. How do you say it? MSNBC or MSNBC? How do you say it? I so rarely.
MSNBC, I guess.
Yeah. Okay. Right. It's okay. MSNBC, and it creates complications because it has a long, tense history with President Trump. That's the basic bottom line, and regulatory approval is less of an issue I'm sure it's no more or less an issue it was in previous decades. But any deal involving CNN inherently becomes a political football. I have a friend in America who is a total Republican supporter, and he calls CNN the communist news network, which is very cynical. But it kind of always reminds me when I try and remember which one is the friend of the Republican Party. Is it CNN or Fox? I always remember him saying communist news network, and I realize Fox is the one. Shows you how
Yeah.
little I watch American TV.
But like, it's a good point, because if you're putting in well, I don't know anything about David Ellison really, but like, as in the son
Mm,
of Larry Ellison, who's a confirmed Trump buddy, if you're putting them in as the new owner of CNN, what happens then? Like, there's so much
yeah.
implications to this deal. Like, in terms of, we're just talking about the content, we're talking about, say, streaming and cinema, but like, talk about news now. Do you
Yes.
know? There's
Totally.
that
Yeah.
kind of equilibrium of sorts of right wing media and left wing media, and then you're bringing in maybe a right wing influenced owner of a left wing traditional media and news network. What
Yeah.
happens then? So it's really up in the air, and you don't really know what's going to happen.
Now, industry, you don't, but industry observers who know are familiar with the matter do think the most likely winner of the bid is Paramount Skydance. That's kind of what those who understand the smaller moving parts in the watch far better than us are saying. And Paramount has spent years trying to scale its studio and streaming operations. They're way behind Disney, clearly. They're way behind Universal and Warner at the box office. And Paramount Plus, which we're a subscriber to because in this house we subscribe to everything. And if I dare suggest we kill a subscription, it's like I've suggested we go move to the jungles of Borneo. But anyway, like Paramount Plus trails all the major streamers in global subscribers, and the company's future depends on gaining scale. Like this
Yeah,
Paramount Plus feels like if you live in an average home with an average subscription to them all, Paramount Plus is the thing you look at when you're clean out of ideas because their library is quite shallow, and that will not hold customers' wallets through thick and thin. It's a almost infinite library is what keeps people there. So they really, I would say, they need to win this bidding war. And when you think of franchises like Mission Impossible and Top Gun sitting alongside Harry Potter and Batman and the Matrix, you suddenly it feels like you've got yourself well, it's not a feels, it's a matter of given fact that you're looking at something that's far more competitive against the others. But the proverbial movie plot thickens. There, as you've already said, are some political dynamics at play. And as you already said, Larry Ellison has long had very close ties to President Trump. And I was reading this thing in the New York Post, I think it was last night. I was reading all around me on this specific subject. Like Ellison has been involved in informal discussions with probably Trump himself about the Warner deal, including topics like CNN's programming. And while none of this is official policy and none of this is formal negotiation, as we've already said, you got to admit it really gives Paramount an edge and a smooth regulatory path. If you were a betting person, I think you'd say, right, the one that would be most favored by all at the table is Larry Ellison. It kind of reminds me of after President Trump was reelected, and next thing, all those who were very Democrat before the election were sitting at the table with him in a matter of weeks, and
yeah.
Zuckerberg came out and changed something to do with. So I can't remember what, but I was like, oh come on, be a man, you multi-billionaire. But I was kind of like, just if you have a belief, stick with it. It made me sick, but I do think
It's
that
it's a
yeah,
very good point, but also, the duty of Warner Brothers Discovery's board is to get the best deal for shareholders, and that's
correct.
irrelevant. Like, as
Yes.
in the how easy the process would be after that fact is
Yes.
kind of irrelevant. It all depends on
Yes.
the offer.
Entirely true.
Yeah,
Absolutely entirely true. Like none of this debate means an outcome is predetermined. And WBD itself really has to just determine how to maximize value. That's their
yeah,
job. they owe it to the people who owe it, and and as a result of this news breaking, the stock has popped in anticipation of a sale, and its CEO David, is it Zaslav? Is that his name, David Zaslav?
Zaslav, yeah.
Yeah, he's under pressure to secure the deal that really does make sure all the major stakeholders, which are shareholders, are happy, that it reduces debt, and I guess preserves Warner's legacy. You can't say that they would not sell someone who's going to ditch the Warner brand. So I think the company really has been getting ready for this separation, and may ultimately choose a hybrid operation,
Yeah.
selling the studios and the streaming to Netflix and Comcast, and spinning off the cable networks thing separately. But what really makes the story so high stakes is what it says about the streaming wars at large. And the era of growth is organic growth. It feels like it's over. There's emerging nations and other countries and stuff, but the adding tens of millions of subscribers per platform per quarter, I don't want to say the sun has set on it, but it's certainly the autumn of that type of growth. And profitability now rules, as I said, and consolidation is the new strategy. And it's this storyboard, whether it's in Hollywood or whether it's in Main Street Dublin. There is no Main Street Dublin. Well, is there a Main Street in Dublin? O'Connell Street in Dublin. Consolidation is the way you go when the organic growth route has kind of come to a small end. And
Yeah.
today's giants are really preparing for a world where only a handful of global streaming platforms remain. I've spoken on the podcast before about the economic rule of three, which really isn't a rule per se, but it's an observation by economists that in every industry, ultimately only three giant dominant players remain after multiple years of slugging it out, when there's lots, but then there's a bunch of boutique players. And I think of Mubi, M-U-B-I, they would be one of the smaller boutique players, but all the big giants are currently trying to figure, but the sharks are circling, and one of them is about to get bigger.
Yeah. Okay. So before we end up, I'll ask you, as a Netflix shareholder, would you what would your ideal situation be? Do you think Netflix are better off without winning this bid, or do you
What
think?
I have so much faith in the management team of Netflix. They are, in their world, so strategically clued in and so astutely aware of the power of cash. I trust that the decision they make will be best for Netflix, but we don't have that information right now. So have they put in a bid in order to play out a strategic game where ultimately they're not going to make the purchase? I do not know. I don't think that's their typical modus, but this is such a big thing. I would imagine management 101, pays to be at the table until we decide we're not at the table. But to your question, when I read through the Warner's Discovery's asset list, it was jaw dropping. There are so many titles in there that are part of our lives, and that will remain part of our lives, and that have a nostalgic long tail that's going to go through for many, many more decades. I think it would be a great acquisition from a content perspective if they structured it in a way that uh, there's no damage done to the battle armor they've got. Now, I do carry the worry about integration, but I suspect their integration view might just be simply we take that content, it lands. I mean, I'm doing the very, very Lego brick view of it. The content arrives on Netflix platform, and all the other stuff that is involved in the package is diligently laid off. Not to that is a clear oversimplification, but to own a studio versus being a content distribution, kind of waffling around the point. What would I prefer? If I'd say yes or no to the deal from where I sit and what I see, I think Netflix could make it on their own without it, and possibly might be better off leaving it. That would be my
Yeah,
kind of sense.
I think I would agree with you. I think it seems a little bit too far away. The fact that they come out and said,
Mm.
"Yeah, we would we would do the full release schedule as Warner Brothers," kind of would itself seems a bit too far away from its core capabilities.
Yeah, Yeah.
And then just the scale of the acquisition compared to what it's done in the past is way beyond anything they've been doing fine by themselves, while all the entire rest of the streaming landscape has kind of floundered. I think I would agree with you. And also, there's a kind of like, as someone who loves going to the cinema, there's a nagging kind of thing in the back of my head of, yes, they might initially, you know, say we're going to release everything in the cinema as it was intended to, but when they realize that that's too difficult or too expensive or not profitable enough,
Mm.
are all the next big cinemas, box office hits going to end up on streaming first? And that doesn't really sit well with me either. So, and again, look, geez, I don't know what will happen if Paramount, Skydance, or Comcast open and they decide, yeah, we need to make HBO Max or Peacock or Paramount Plus the biggest streaming service ever, and we're going to release the next Batman on streaming and not touch the cinema. That's an issue
Yeah.
too. But
Yeah.
maybe that's just kind of like peeing into the
Yeah.
wind in terms of those worries, and it's going to happen either way. But
And can you
yeah,
imagine the amount of logistics behind all of those considerations? And you
yeah,
can just see very simple assessment. If there's a great new movie, Acme movie, everyone has to see it. And Netflix goes, it's not going to cinema, it's going to our platform because we know that's going to increase our subscriber slash profit by X. It just, you can see how it's a body blow to cinemas, which is the point you made at the top of the segment.
yeah, it's brass tacks.
Yeah, for sure.
But it'd be interesting to watch it play out. I think Warner Brothers said they'd look to finalize the sale before the
Mm.
end of the year, so
Yeah.
we'll find out
Yeah.
soon enough.
We will indeed.
Uh,
And we'll revisit it here in Stock Club and say who won the race.
Yeah, maybe it'll go as usually happens with this podcast. The deal might be finalized in between recording and publishing, Emmet.
Oh
So
yeah, it's
we've
announced
wasted
as soon as I
25
go
minutes of
see
our
him. I
lives.
talk to you tomorrow. Yeah, that's it. Yeah, for sure.
Okay, we'll finish it out there. But just a reminder, if you are interested in the Nexus 3 offer, to email in at frank@mywallstreet, mywallst.com, to take advantage of that while it is still on, because after Friday, that's the end of it. Emmet, thank you for joining. Everyone else, thank you for listening in. If you haven't already, please do subscribe, whether it's on Spotify, Apple Podcasts, YouTube, wherever you're listening. It does help the show. And yeah, we'll talk to you next week.